If you have heard the term DSCR in the realm of home loan financing, but don't know quite what it is or maybe exactly what it means, then you are in the right place. I'd like to welcome you, Matt, the Fish and Finance guy here. And if this is your first time to my channel, welcome and thank you for tuning in. And if you've been here before, thanks a bunch for coming back. What I'm going to do today is break down, in terms of a broad overview, what exactly a DSCR loan means and what it may be able to do for you. Now, this is a product that has been somewhat new to the mortgage lending arena going back over the last couple of years. And if you are a current and active real estate investor, or if you are looking to get into real estate investing for the first time, this product could very well be the solution for you. So, what exactly does DSCR stand for? Well, it stands for Debt Service Coverage Ratio. So, what exactly does that mean? Well, in its simplest form, what we as a lender are looking at if you're going to finance a rental property with a DSCR loan is we're analyzing the cash flow of the property relative to what the full principal, interest, tax, and insurance mortgage payment looks like. So, just as a very straightforward, simple example here, if you were purchasing a home and the all-inclusive PITI monthly payment for that home was going to be $2,500 per month, and the projected rental income from that property was also going to be $2,500 per month, then you would be looking at a 1.0 ratio, simply meaning that the amount that you're going to owe in your payment is being covered in total by the amount of the rental income received. Now, depending on what those numbers look like, it's going to impact what that ratio is as far as that debt service coverage, and that can impact the pricing and the details on the transaction. But for the sake of this video, I don't want to get into guidelines and matrices and all the different little variables and details. I simply want to give you an overview of what makes a DSCR loan different than most other mortgage loan products out there in the market. So with that being said, let's dive right in. So difference number one, there is no personal income or employment verification required within the profile of a DSCR loan. So whether this is Fannie Mae or Freddie Mac with a standard conventional loan, or FHA or VA or USDA, or even in most cases a home equity line of credit or a home equity second loan, personal income is evaluated and it is part of the loan file to help determine how much you can qualify for. So in the case of a DSCR loan, we are not looking at your personal income nor your personal employment. So depending on what your circumstances are, this may be a viable option and a very good solution for you to move into or further expand your rental real estate portfolio. Now, if you're already an active investor, you may have a handful of rental properties already within your portfolio. But when we as lenders look at your tax returns and we see what the cash flow looks like on all of your rental real estate, it's a little more complicated than just what you are typically going to be analyzing and looking at. So as an example of what I mean there, you might have a rental property that has a mortgage payment of $2,800 and you're currently receiving monthly rental income on that of $3,200. So right off the bat, you're looking at the gross raw numbers and thinking to yourself, well, I own this piece of real estate, it's making me $400 a month. But how that all breaks down on a tax return and gets analyzed by a lender may be a good little bit different than that. So you could find yourself in a traditional qualifying capacity, maybe not meeting the guidelines on a Fannie Mae or Freddie Mac loan as far as debt ratio and income versus adding another property in. So this product could very well be a solution, since the qualifying is solely based on that cash flow analysis of the property. So, with that being said, what is kind of bullet point number two that makes a DSCR loan different? So, essentially, it's what we just touched on, which is the qualifying for the transaction is based on the property and not so much you, as far as how do the numbers look from the standpoint of this property being able to cover itself, if you will, based on the mortgage payment that you would be pulling and obtaining when you finance the home, as compared to what the projected rental income based on current market conditions in the area that the home is located are going to dictate. So, again, not needing to resort to personal revenue or personal income verification in any capacity, but merely an analysis of the property itself and how does it look like it will perform based on the dynamics associated with the property. So that leads us to bullet point number three, as far as what makes this loan a little more unique or different than traditional financing. And that would be simply that this product is specifically built for investors. Now, when it comes to, let's say, an FHA loan, a VA loan, or a USDA loan, those all can essentially only be used for personal primary residence transactions. Now, when you look at standard Fannie Mae and Freddie Mac conventional financing, that is usually the product realm where people are going to look to qualify for either a primary residence, a second or a vacation home, or possibly an investment property. So, since Fannie and Freddie are really the only standard financing out there for an investment property, again, you are possibly going to find yourself limited because of the income analysis and the debt ratio limitations that are imposed on those loan programs. So, again, if you are finding that looking to put your first rental property into action, or you are looking to expand on an existing portfolio, is proving to be challenging due to traditional qualifying methods, this again may be an awesome solution to help you overcome that hurdle. Now, that leads us to bullet point number four. Since personal income documentation, employment history, and employment verification are not required on this particular product, it is a case of very reduced documentation for the file. So while assets going into the transaction to cover down payment and closing costs and other expenses associated with the acquisition of the property are going to be verified in a standard and traditional way, as the case would be with any other mortgage loan, everything else pertaining to employment and income and employment history is not part of the application. So you're then basically left with things like a copy of a lease agreement, if there is one in place or one that you're putting in place for the property, a copy of an appraisal, and then when the appraisal is done by the appraiser, they are also going to include a supplement that is known as a rent schedule, and that is essentially a fair market analysis of what that subject property is possibly going to be able to generate in terms of monthly rental income based on the area and other details of rental properties in that market. So that then leads us to bullet point number five, and that is very simply that this product line is business friendly as far as the ownership details. So when looking at all of your other standard and traditional loans, in just about every case out there, it is not possible to take title to the property in the name of an LLC or a business entity. When you are utilizing your standard and traditional loan products, title usually needs to be taken in your personal name or possibly in the name of a family trust. But if you want to put the property into the name of a business, it essentially creates a layer of separation between the mortgage side of the market or the lender or investor and yourself. So in the event of delinquencies or a default, it is more difficult for the lender to pursue foreclosure on the property. So when you are using those standard and traditional types of financing, usually LLCs or business entity ownership are not allowable. Whereas in the sense that this product is specifically designed for investors, titling in the name of your rental real estate portfolio business. I know there are instances where people will create a separate LLC for each property that they own, and the LLC name might be the address of the property followed by LLC. So there's lots of variables and variations out there. But understand that with this product line, if you are interested in putting the property title and ownership into an LLC or a business, in most instances, it's going to be allowable and viable as long as we have the ability to review any paperwork and documents pertaining to the business or the LLC, simply confirming that you are the owner of the business and some other details in that regard. And that leads us to our final point here, and that is simply that there are lots of variables and options and flexibility and variances on the interest rate on these products. So I will get into more depth with some of these topics in future videos, but understand that with this product, the interest rate on the loan itself could be slightly higher than what you might expect to see with other traditional financing. Now, with that being said, there are a number of variables that are going to impact exactly what your interest rate and final pricing and details look like. So those variables could be, what is the projected rental income relative to the mortgage payment? So if that rental income is a little below what the mortgage payment is, statistically, that is going to be a riskier loan. So the pricing is going to not be as attractive or favorable as if the rental income equals the monthly mortgage payment or exceeds the monthly mortgage payment. So that's one variable. Your level of down payment going into the transaction is going to impact your pricing as well. So typically the cost of entry is going to be 20% down to play in the DSCR sandbox. But as you move to larger down payment levels of 25 or 30 or 35 or 40%, it is less risk to the investor, obviously, with a larger down payment. So pricing is typically going to improve as a result of that. Now, because these are designed for investment property transactions, they are not subject to some of the same rules and regulations that standard single family primary residence or second home or vacation home guidelines call for. So prepayment penalties are something that come into play on this product line. Now, they're not mandatory per se, but if you choose for a no, or let's say a very short prepayment penalty of maybe 1 year, you are going to see that reflected in your final pricing and details. So there's a lot to unpack there, but that is a component within this product that is going to be a little different than just about every other mortgage product out there. Another element that will come into play and impact what your pricing and details look like are what your credit score is. So depending on where your credit score falls in that spectrum and that range of where credit scores can be, that is going to impact the pricing as well. So that's it in terms of this overview of DSCR loans. I truly hope you found this informative and beneficial if you are considering getting into real estate investing, or if you are currently a real estate investor and looking to add more properties to your portfolio. Please don't hesitate to reach out. If you are looking for a property anywhere in the state of Florida, I would be more than happy to have a conversation with you and see if one of these products might work well for your next investment. And I thank you again for tuning in. Matt here, the Fish and Finance Guy, signing off for now. If you have any specific questions about anything pertaining to mortgage financing or anything else about the Southwest Florida market, please go ahead, drop a comment down below. If you have any topics that you would like me to cover, feel free to drop a comment down below, and I'd be happy to see if I could put together a video to answer your specific request, and then obviously be able to share that with everyone else out there. Thanks again for tuning in. We'll see you next time. If there's ever anything I can do for you, please don't hesitate to reach out, even if it's just a simple question about anything pertaining to home loan financing. Happy to help in any way that I can. Make it a great day, and I will look forward to seeing you in future videos. Well, hey there, if you are still with me, thanks for sharing a little time with me today. I hope you found this video helpful and informative at any point, and whether that is 2 weeks, 2 months, or 2 years from now. If you have any questions about financing or mortgages for any type of property located anywhere within the state of Florida, please feel free to reach out. I'd be more than happy to have an initial consultation with you, learn a little bit about what your needs, wants, and desires are, and see if we can come up with a loan program custom suited to take care of your situation. If you are self-employed, we have solutions in the market today that can help you with that as well. If you have ran into financing issues due to self-employment in the past, and if you are seeking standard, traditional, regular financing, we do all those loan programs really well as well. I would be more than happy to consult with you and put my team to work for you. Make it a great day. Thanks for watching, and I'll look forward to hearing from you if there's anything you'd like to discuss. This is Matt, the Fish and Finance Guy, proudly representing Main Street Home Loans, NMLS ID 296861, and we'll see you again in the next video.